Imagine a single company goes public, and overnight, your retirement account is literally forced to buy billions of dollars of its stock.
Right. Even if that company is currently losing billions of dollars a year.
Exactly. I mean, that is exactly what's about to happen with SpaceX's upcoming initial public offering. So welcome to this deep dive. Today, we're looking at a huge stack of financial filings, market analysis, and, reporting on what's expected to be a June 2026 IPO for SpaceX.
And we are looking at a staggering valuation here, roughly $1.75 to $2 trillion.
Yeah, trillion with a T. It's wild.
It really is. And just to set the parameters right away, we aren't here to debate the thrust capabilities of the Starship rocket or, the timeline from a Mars colony.
No, we are sticking to the money today.
Right. What's fascinating here is our mission today is to unpack the pure financial mechanics of this specific IPO. We need to analyze how it is literally rewriting the rule book for major index funds.
And what that means for you, because, well, we want to explore why passive retirement accounts are going to be forced to absorb massive amounts of these shares, completely independent of whether you, the actual investor, want them or not. Okay, let's unpack this, because the sheer scale of what we're talking about is, it's just really hard to wrap your head around. SpaceX is looking to raise about $75 billion.
Right.
But here is the mechanism that essentially breaks everything. They are only floating 3 to 5% of their total shares to the public.
Just a tiny fraction.
Yeah, the vast majority of the company remains completely locked up.
And that collision right there between a massive historic valuation and a tiny supply of public shares, that is the central engine of this entire story.
It's creating a total bottleneck.
Exactly. It's a mechanical bottleneck that is upending the entire passive investing industry. To understand how that works, we first need to look at the anatomy of this mega IPO and, what a $2 trillion price tag actually represents.
So let's put that number into perspective. When Amazon went public back in 1997, the entire company was valued at, about $438 million?
Around there, yeah.
So SpaceX is entering the public market roughly 4,000 times larger than Amazon was at its IPO. I mean, it is completely skipping the normal growth phase that usually happens on the public market and just arriving as this fully formed Leviathan.
It's unprecedented.
Yeah.
And financially, it's an incredibly unique profile. You have a business generating massive revenue, but also
Burning through cash.
a mountain of cash.
Yeah.
In 2025, SpaceX brought in $18.67 billion in revenue.
Oh, yeah, that's huge.
But they reported a $4.94 billion net loss.
Wait, almost $5 billion in losses?
Yeah. And the burn rate is actually accelerating. If we look at the first quarter of 2026 alone, they posted a $4.28 billion GAAP loss in just 3 months.
A $4 billion loss in a single quarter. Jeez. Where's all that money going?
Well, it's driven heavily by research and development for the space program, obviously. But crucially, it's also being consumed by incredibly expensive artificial intelligence infrastructure.
Oh, right, because of XAI.
Exactly. They are rolling in the operations of XAI, which requires just a staggering amount of compute power and capital expenditure.
So looking at that tiny float combined with those massive losses, I mean, it really just feels like a massive stadium concert.
How do you mean?
Well, imagine you've got a venue that holds 100,000 people.
But,
That represents the $2 trillion valuation.
okay, not fun.
But the band is only selling tickets for the first 2 rows.
Ah, right. That's the 3 to 5% float.
Exactly. It creates this totally artificial frenzy where everyone is fighting for a handful of available seats. But I have to ask the obvious question here. How does a company losing nearly $5 billion a year command a $2 trillion price tag? Like, what is the market actually buying?
The market is pricing in absolute undeniable monopoly power. Investors are looking at total dominance in commercial space launch. And they're looking at Starlink, which is rapidly transitioning from, a novel consumer product into a literal global utility for satellite internet and defense communications.
Right. It's everywhere now.
And with that XAI integration we mentioned, they are pricing in the future of artificial intelligence compute. I mean, the institutional believers aren't valuing the company based on today's balance sheet. They're valuing a future where SpaceX controls foundational infrastructure for both the planet and, frankly, beyond it.
But regardless of whether that thesis is correct, your stadium analogy still holds up, I think.
Oh, definitely.
Because the critical issue isn't whether the company is going to succeed or fail over the next 10 years. The immediate issue is that the tiny supply of shares means there simply aren't enough to go around if the major index funds are suddenly forced to buy those front row tickets.
which leads us directly to the rulebook. Because the float is so small and the valuation is so immense, the companies that run the major indices like the S&P 500 and the Nasdaq 100 faced a really severe dilemma.
Right. What do they do?
Exactly. Do they ignore the biggest IPO in history because it doesn't fit their traditional parameters? Or do they rewrite their own long-standing rules to force it in?
And spoiler alert for everyone listening, they rewrote the
Really
rules.
good time.
But before we get into the new rules, what were the old safeguards? Like, what was the standard operating procedure before this massive IPO just warped the gravity of the whole market?
Well, historically, index inclusion wasn't an overnight process. The S&P 500 required a company to really prove itself. You needed 4 consecutive quarters of GAAP profitability.
So actual earnings.
Right, actual money being made. And you needed a minimum of 12 months of public trading history before you could even be considered. The Nasdaq was a bit faster, requiring 90 days of trading. But the philosophy behind it was simple. Let the market discover the true price of the stock, let the initial IPO hype burn off, and ensure the business is actually financially viable.
But now we're seeing the gates just swing wide open. I mean, the NASDAQ has created this fast entry rule allowing a company to be included in just 15 days.
Yeah, from 90 days down to 15.
And they removed their old 10% minimum float requirement entirely. And here's where it gets really interesting. They are applying something called a 3x float multiplier to artificially inflate SpaceX's weighting in the index.
Yep. And meanwhile, the S&P 500 has proposed waiving that profitability requirement entirely. Plus, they're cutting the seasoning period from 12 months down to 6 months for mega-cap companies, and it goes even faster depending on the fund. CRSP, which is the index provider that dictates the rules for Vanguard's massive total market funds like VTI and VT, along with FTSE Russell, they're implementing 5-day fast tracks.
5 days.
5 days. They're waiving their normal minimum float rules entirely, provided that certain staggered lockup agreements are met over a 12-month period. Think about the magnitude of that shift. A process designed to take a full year of rigorous financial auditing and price discovery is being condensed into 5 single trading days.
That is insane. But let's zero in on that 3x float multiplier that the NASDAQ is using, because this is where the math gets genuinely wild.
Absolutely.
That is like grading on a curve, but, only for the most popular kid in school. It's like the teacher pretending a student answered 3 times as many questions as they actually did on a test, and then forcing the school board to fund a massive scholarship based on that fake score.
That's a pretty accurate way to look at it.
If the shares aren't actually available to trade because they're locked up by insiders, why is the index algorithm pretending they exist?
Well, if we connect this to the bigger picture, it comes down to a concept called tracking error. Index funds sell themselves to investors on one core promise. We will accurately reflect the performance of the broader market.
Right. You buy the index, you get the market.
Exactly. So if SpaceX stock moons like, if it doubles or triples in value after the IPO and the Nasdaq 100 or the S&P 500 doesn't own it, those indices will severely underperform the overall market. The fund managers are absolutely terrified of that scenario.
Because if the index underperforms, investors pull their money out and the fund managers lose their fees.
Precisely. So the rules are being altered to protect the relevance and the performance of the indices themselves. But critics are pointing out that this self-preservation comes at the direct cost of everyday investors. We're losing the traditional safeguards that prevented passive funds from buying into massive hype cycles before a company even proved its profitability.
So the NASDAQ is effectively rigging the scale with this multiplier. But what does that rigged scale actually do to the money sitting in our listeners' 401ks? If we trace the actual dollars, the impact depends entirely on which index you hold.
Oh, it does. Let's look at who is buying this, when, and how much.
Okay, let's start with Vanguard's total market funds, VTI and VT, which follow that CRSP index.
Right. Because of their 5-day fast track, VTI and VT will absorb SpaceX almost immediately. But importantly, CRSP does not use that artificial 3x multiplier.
Oh, okay.
Because they are relying on the actual tiny float, the exposure will be relatively modest.
Analysts estimate it will be about $70 to $110 of SpaceX stock for every $100,000 you have invested in those specific Vanguard funds.
Okay, 70 to 100 bucks out of 100 grand.
Yeah.
That seems perfectly manageable. But then we look at Invesco's QQQ, which tracks the Nasdaq 100.
Yes, and that is a very different story.
They added in 15 days. And because of that artificial 3x multiplier, SpaceX is going to be heavily weighted. It's expected to be somewhere between 0.47% and 0.70% of the entire index, which is massive.
It is. That forces over $7 billion in pure mechanical buying.
Let's pause and break down the literal mechanics of that. Wait, so if QQQ has to buy $7 billion dollars of SpaceX on a specific Tuesday afternoon, they literally have to sell off proportional bits of my Apple and NVIDIA shares to afford it, right?
Yes, that is exactly the mechanical reality of how index rebalancing works.
How?
A passive fund doesn't just have a giant pile of uninvested cash sitting around waiting for an IPO. To buy a massive new asset, the algorithm must systematically sell fractions of their existing holdings to make room.
And when $7 billion dollars of forced buying hits a stock that only has a 3% public float, what happens to the price?
Well, this is where we have to look beyond just the stock supply and look at the options market. Spot Gamma actually released an analysis pointing out that this setup is a textbook trigger for a gamma squeeze.
Okay, break that down for us, because a gamma squeeze is often misunderstood as just, low supply meeting high demand, but it's actually about options, isn't it? Exactly. A gamma squeeze happens in the derivatives market. When retail traders and speculators flood in to buy call options on SpaceX, essentially betting the price will go up, the market makers who sell those options have to protect themselves.
Right, they don't want to get wiped out.
Think of a market maker like a casino taking bets. They want to remain neutral. They don't want to take on massive risk. So to hedge against the risk of the stock price rocketing upward, the market maker goes out and buys the actual underlying stock.
So the higher the stock price climbs, the more stock the market maker is forced to buy to cover their options exposure.
Yes, it creates this intense upward spiral. You have retail buying options, which forces market makers to buy the stock, which pushes the price higher, which forces more hedging.
It's a feedback loop.
A vicious one. And all of this is happening in an environment where the supply of actual tradable shares is artificially restricted to begin with. Add the $7 billion dollars of blind algorithmic buying from the NASDAQ, rebalancing into that powder keg, and you have the ingredients for unprecedented volatility.
Because the index has to buy.
Right, the passive index isn't buying because it likes the valuation. It is buying because the algorithm demands it at literally whatever price the market dictates at the closing bell on rebalance day.
That is just wild. And looking further down the road, we have SPY and VOO, which track the S&P 500.
Yep.
They are expected to add it in 6 months, so late 2026. The expected weight there is 0.08% to 0.12%, which triggers an additional massive wave of $8 billion to $12 billion in forced buying.
And we also have to acknowledge the massive exposure that exists in the retail market right now, pre-IPO. There are funds that have been accumulating private shares for years.
Right. It's not just the new buyers.
Exactly. The Barron Partners Fund currently holds a 33% weighting in SpaceX. The ER Shares Private Public Crossover ETF, ticker XOVR, they recently hit a 42.7% weighting due to outflow imbalances with their public shares.
And we're also seeing retail investors seeking exposure through closed-end funds like the Destiny Tech 100, ticker DXYZ, and ETFs like the Team of Space Innovators, ticker NASA. They hold large chunks of private equity too.
Absolutely. The Fidelity Contra Fund holds the largest absolute dollar amount at over $8 billion.
Yeah.
Even Alphabet, which made an early venture investment in the company, holds roughly a 5 to 6% stake.
Alphabet. Really?
Yeah. At a $2 trillion valuation, Alphabet's stake alone could be worth over $100 billion.
Which means if you hold Alphabet shares, you are basically sitting on a massive SpaceX proxy without even realizing it.
You really are.
So with tens of billions of dollars in forced buying effectively locked into the calendar and all this pre-IPO retail exposure, how are financial professionals and market analysts reacting to this? Because, reading through the sources, the landscape is incredibly divided.
The divide is profound, and it really represents two entirely different philosophies of valuation. On the bullish side, you have investors like Ron Barron. He is incredibly optimistic, stating he believes SpaceX will eventually be the largest company on the planet.
Wow.
He is projecting a future valuation of $10 to $30 trillion. And his firm has actually pledged to buy another $1 billion worth of stock right at the IPO.
But the traditional market critics are sounding massive alarm bells. Jason Zweig at the Wall Street Journal called these index rule changes arbitrary, unfair, and potentially risky.
Right.
And Robin Wigglesworth at the Financial Times went even further. He called this the biggest bag holder exercise of all time. The bears are arguing that everyday passive investors are essentially being used as exit liquidity. Like they're being forced to buy the absolute top of a private market bubble just so early venture capitalists can cash out.
And that sentiment is heavily echoed across retail forums like Reddit and Hacker News. There is palpable outrage among certain segments of the retail investing public. They view the dilution of these index rules as a betrayal of the whole passive investing thesis.
Yeah, the rules are supposed to protect them.
Exactly. And we also have to report, based on the source material, that a significant portion of this retail backlash is tied to the political and social controversies surrounding Elon Musk, as well as the debt associated with the acquisition of X, formerly Twitter, potentially being entangled with SpaceX.
And it is vital to state clearly for our listeners right now, we are entirely neutral on this. We aren't taking a side on whether rolling XAI or navigating the complexities of the X acquisition makes SpaceX a brilliant business or a terrible one.
Right. That's not our goal.
We are simply reporting that this polarization, both the fierce loyalty of the bulls and the intense skepticism of the critics, is a major driver of the debate we're seeing in the public forums. People are deeply divided not just on the financials, but on the broader implications of what they're actually funding.
Right. And to understand how this mechanical force buying might actually play out on the charts, we can look at the most direct historical precedent we have, which is Tesla's inclusion to the S&P 500 back in 2020.
Oh, yeah. What happened then? Because that was also a completely unprecedented event at the time.
The mechanics were fascinating. What we saw was a massive run-up in the stock price in the weeks leading up to inclusion. This was driven by front-running. Active traders and hedge funds knew the passive index funds were going to be forced to buy billions of dollars of Tesla on a specific date.
So they got in first.
Exactly. The active traders bought the stock early, driving the price up, knowing they could literally just sell it to the blind algorithmic buyers at a premium later.
The passive funds were basically walking into a predictable trap.
Yes. Then, on the actual day of inclusion, we saw a record-breaking volume spike as the mechanical flow finally hit the market. And immediately after that inclusion day,
Did it drop?
the stock traded sideways and downward for weeks. The mechanical force buying had exhausted itself, the active traders took their profits, and the organic demand had to eventually catch up to the inflated price.
So what does this all mean? If we synthesize everything we've unpacked today, it really comes down to a battle of fundamental beliefs intersecting with broken market plumbing.
That's a great way to summarize it.
I mean, on one hand, you have investors who deeply believe they are buying into a generational, multiplanetary tech monopoly that will define the next century of infrastructure and AI. And on the other hand, you have critics who believe the public is being strong-armed into bailing out private debt and funding speculative ventures at peak hype.
And beyond the fate of the company itself, this raises an important question about the very nature of modern investing. Are index funds actually passive if a small, centralized committee of providers can arbitrarily change the rules to accommodate a single, powerful company?
That's a great point.
When the foundational rules flex this much to chase the market, the line between passive indexing and active management starts to blur significantly.
Definitely.
Hmm.
So to wrap up this deep dive, we want to remind you that while the SpaceX IPO is undeniably a historic milestone for space exploration, it is arguably an even bigger event for the mechanics of the stock market itself.
Unquestionably.
Whether you actively log into your brokerage to buy the stock on day one, or you just passively hold a standard total market fund in your 401k, you will be participating in this IPO. The market infrastructure has literally been rewired to ensure it.
And I'll leave you with a final thought to mull over. We've spent this entire deep dive talking about SpaceX breaking the mold and forcing index providers to bend to their will. But as the rigorous historical rules of the S&P 500 and the NASDAQ can be rewritten virtually overnight to accommodate this one company, what happens when OpenAI and Anthropic go public later this year or next?
Oh, wow. I didn't even think about that.
Are we entering a new era where the massive, unprecedented valuations of private AI companies dictate the rules of the public stock market, rather than the public market dictating the standards for the companies?
It's a fascinating paradigm shift. The tail is suddenly wagging the dog. Keep questioning what is actually inside your passive portfolios and, how those decisions are being made on your behalf. Because the rules simply aren't what they used to be. Thanks for joining us on this deep dive.